I don't compete, I dominate. And that's the mindset and mentality you need to have when you look at that person in the mirror every single day. It's you against you, bro. Every day you go harder than yesterday, right? Do more than you want to do and be better than your current self. Every day, keep going hard. We're going to cover the best ICT trading strategy in this video. But real quick, I want to talk about patience and delayed gratification in Forex trading, which is the key to long term trading success, right? So, patience and delayed gratification, they are essential skills in Forex trading. Successful traders, they don't chase quick profits, they wait for high probability setups and they trust the process, right? We're going to break down the importance, challenges, and how to develop these traits for long term success in Forex. So, what is patience in Forex trading? Patience in Forex trading means waiting for the best trade setups instead of forcing trades, allowing trades to develop without exiting too early, sticking to your trading plan even during losing streaks, and understanding that consistency over time it does lead to success. Patience, it separates professional traders from amateurs. Impulsive traders, they react emotionally to market movements, while patient traders wait for confirmation before acting. Okay. Um, so, what is delayed gratification in Forex trading? Delayed gratification means sacrificing short term rewards for longer term probability. Traders who master delayed gratification avoid taking random low quality trades just to feel active. They also stick to their trading strategy even when they could make quick money. They compound their profits over time instead of risking too much for fast, quick gains. And they understand that small, consistent wins lead to long term wealth. An example, so a trader with delayed gratification will wait for the perfect setup instead of forcing a trade, stick to a risk management plan, even if it means smaller short term profits, focus on the long term equity curve rather than immediate gains. Okay. So, why most traders struggle with patience and delayed gratification is the need for constant action. Many traders, they feel this urge to always be in a trade, fearing they might miss out. That's FOMO. Trading too often, it leads to over trading, which increases losses and emotional fatigue in trading. The solution is to accept that not trading is also a position too, right? Sitting on your hands and not taking any trades. You want to remind yourself the market will always provide new opportunities, and you want to set a rule to only take trades that fit your strategy 100%. Okay. The fear of missing out, aka FOMO, this happens when you're seeing big market moves, which makes you as a trader jump into trades without proper analysis. And they may enter late, risking poor trade placement and leading to unnecessary losses. And the solution to that is to use a trading journal to track how many times FOMO has led to your losses and recognize that missing one trade, it won't make or break your trading career. And you want to train yourself to wait for setups that align with your trading edge. Three, cutting profits too soon. This is another reason why most traders struggle with patience and delayed gratification. Traders close winning trades early because they fear losing profits. Instead of letting trades reach their full potential, they take these small profits. And the solution to that is to trust your risk to reward ratio. If your target is a 1 to 2R, let that trade run. It's either going to hit profit or stop loss. Okay. And then follow a trailing stop instead of exiting emotionally, and track your past trades to see how many could have been bigger wins. Okay. And then the last reason why most traders struggle with patience and delayed gratification is not sticking to a trading plan. Impatient traders, they abandon their trading plan after a few losses, and they switch to these strategies real frequently, searching for the perfect system. And the solution again to that is to backtest your strategy, and you want to build confidence in its long-term profitability, and you want to commit to a sample size of at least 50 trades before making any changes to your approach, and understand that no system, trading strategy, approach wins all the time. Just stick to your edge. The benefits of patience and delayed gratification in forex trading leads to higher quality trades and a better win rate. So when you're waiting for the best setups, it leads to higher probability trades, and this reduces the number of lower quality trades and emotional trades. Okay. And then an example of that would be like a patient trader. They wait for price to come into their fair value gap. They wait for a strong confirmation instead of entering just impulsively as soon as it taps into that gap or something, you know? Another benefit is it reduces that emotional stress and burnout because you're trading less frequently, which reduces emotional decision making, and less stress leads to better focus and consistency in your trading. An example of that is instead of chasing a trades like all day long, a patient trader, they wait for 1 to 2 high probability trades. Okay. And then another benefit is you're more consistent with your profits over time. Delayed gratification means focusing on long term probability. Traders who avoid shortcuts and compound their gains, they build this sustainable success. So a trader who reinvests profits and risks only like 1 to 2% per trade, they grow their account a lot more steadily. And then another benefit is you end up mastering your trading psychology. The ability to wait for great setups, it builds this self-control and discipline. And these traits, they make you as a trader less reactive to all this market noise. So a disciplined trader, they don't panic during a drawdown because they trust in their system. All right. So, how do you develop patience and delayed gratification in trading? Well, firstly, you want to have a clear trading plan. Set a strict entry and exit rule and only trade when they align. And define your risk per trade so you don't over risk out of impatience. And then review your plan daily to reinforce your discipline. Okay. And then, like a good tip for that is to create a checklist before entering a trade. If the setup doesn't meet all that criteria, then do not take that trade. Okay. Secondly, you want to use a trading journal. Track your best versus your worst trades to identify impatience patterns, and write down how you felt before and after each trade, and then review past FOMO trades to see how many led to those losses. So another tip is to, like, before entering a trade, ask yourself, am I following my trading plan or am I rushing into this trade? Okay. Thirdly, you want to train yourself to wait for setups. Set a rule. If the setup isn't perfect, then don't trade. Sit on your hands. Do not press that buy or sell button. Backtest your strategy to build the confidence in waiting for your setup, and remind yourself quality over quantity is what wins in this game. If you feel impatient, just step away for like 10 minutes and don't force that trade. Okay. The fourth thing is to visualize that long term goal. Imagine your ideal trading future. Manifest that, really visualize that. Consistency, financial freedom, stress free trading, 10K per day, all of that cool stuff. Visualize that, okay? Imagine your ideal trading future and recognize that delayed gratification leads to that goal. And understand that chasing quick wins leads to inconsistency. So before trading, say, I trade for long term success, not quick money. And then five, you want to set daily and weekly trading limits. So you want to limit yourself to set to a set number of trades per day or per week. Okay. You want to take mandatory breaks to avoid these impulsive decisions. And if you meet your daily loss limit, then stop trading for the day. Just close your charts and walk away. Many top traders, they only take 2 to 5 high quality trades per week. Less is more, truthfully. It really is. My final thoughts on mastering patience and delayed gratification in Forex trading. These are the foundation of successful trading. They help traders avoid impulsive mistakes, wait for high quality setups, stick to their trading plan, focus on long term success, not quick wins. A key reminder is the best traders aren't the ones who trade the most, they're the ones who wait for the right moments. All that being said, let's go ahead and pull up the charts and go over the best ICT trading strategy. And this is opinionated. I truly believe that this is the best approach. This will tell you everything that's going on in these markets and everything that you really need to know from the higher time frame to the lower time frames. This will give you entry opportunities. This will give you outlook, bias, the whole nine. Okay. So if we delete everything on our charts, I always recommend to start out on the weekly time frame. The weekly time frame is going to be your bread and butter time frame. So what we look for on the weekly time frame is we look for external range liquidity to internal range liquidity, right? So the market moves up or it will move down, right? So internal range liquidity, if it's moving down, it's going to pull back into this range right here. This is internal range, and the liquidity is either going to be like a fair value gap or an last up close candle. So like an order block. Same thing here. It'll be like a fair value gap that price will retrace into, or it'll be like the last down close candle for like an order block or something like that, right? So like if we're looking at the charts right here, for example, you see how price retraced into this fair value gap right here, right? So price expanded, it came down, and it tapped into this external range liquidity here, came up, and it targeted this internal range, and then it tapped into these last up close candles. This is going to be your bearish order block right here, these last two up close candles here. Boom. Price has a reaction off of that, taps into that bullish order block, or not order block, bullish fair value gap right here. Once price taps into that bullish fair value gap right there, that's whenever you can look for like buy opportunities. Whenever it taps into that sell order block, you can look for sell opportunities, but you want to trade with the direction, right? What is price currently doing? So if you notice, price was making these higher highs and creating these bullish fair value gaps, closing over down close candles, disrespecting them, and respecting up close candles, right? In this situation, we had price, if we just look in the past a little bit, we had price bullish, come down, respect this internal range liquidity. It tapped into this fair value gap and this down close candle, had a movement away, targeted this external range liquidity up here. And so in my eyes, I'm like, this is still bullish, right? And if we retrace, we'll probably retrace back into this down close candle right here, or we also have this other down close candle right here too, right? This is where we can potentially find some sensitivity in the market to look for a buying opportunity. And then whenever you start looking for this order block right here, you can see this swing low right here, liquidity that was engineered whenever price tapped into this order block here and it moved away. So when price comes and it sweeps out that liquidity, even this liquidity right here, it sweeps that out. That's called a turtle soup, right? Because it's within the internal range, right? So if we're looking for buys, if we're like in this buying again, where we have the expansions going up, taking higher highs and respecting these bullish PDAs. So when they're respecting bullish PDAs, disrespecting bearish PDAs, your ideology is this is bullish. Why would you think it's bearish, right? So because it's bullish, if you look at swing lows, if they get swept, you look at that as a turtle soup. External range liquidity, if it's bullish and it takes out highs, that's not a turtle soup. That's just external range liquidity. Turtle soups are swing lows that get taken out in a bullish environment, or swing highs that get taken out in a bearish environment. Those are turtle soups for you, okay? This right here would be a turtle soup opportunity that tapped into this bullish FEG. What else did it tap into? We also have this bullish I said bullish FEG, this bullish order block, and we also have this bullish FEG right here that price also tapped into, and it looks like it respected, right? So with all of that in mind, you can see that price then expanded up towards external range liquidity right here, took out these highs here. Now from external range liquidity, it retraces into internal range liquidity. What's that going to be? We have this fair value gap here. We have this down close candle here. And if it comes all the way down here, that's going to be a turtle soup. Anytime price taps into these levels, you're just going to drop to the lower time frames, which we're on the weekly. So we would drop to the 4 hour, and you would look for like market structure shift opportunities bullish to then look for buy opportunities and confirm the reversal, right? These are just areas of sensitivity, and we don't know if price is going to actually have a reaction off of them. We can't predict that. We just have to wait for price to get into them and then look at the lower time frames to see if the lower time frames are starting to disrespect old bearish PDAs, start creating new bullish PDAs, fair value gaps, order blocks, closing over down close candles, and all of that good stuff to then tell us that price is starting to reverse, right? So like right here, for example, when price taps into this area down here, okay, price taps into this area, that's a turtle soup in my eyes. Whenever we see that, we drop to the 4 hour and we start looking for that reversal. What kind of reversal do we look for? We look for, it's like a market structure shift, change in state of delivery, creates that breaker or mitigation block. It's all the same approach, bro. Truthfully, it really truly is. You're just looking for some displacement that disrespects old bearish PDAs and creates and respects new bullish PDAs, okay? What are PDAs? I know I've been saying that a lot. If you don't know what a PDA is, it's a premium discount array. That's just a very special term for fair value gaps and order blocks and external range, internal things like that. You know what I mean? So like it's all the same, bro. Like truthfully, ICT came up with so many different terms and words and everything. A lot of traders, students, even himself can argue that they're all different. Everything is different. But bro, literally I'm sorry, dude, and this could be opinionated, but it is all the same. Whenever you apply every single technique that he teaches, they just all really have different names, right? But they're all the same approach and the same strategy and the same technique. It's just different names to them. Silver bullet model. That happens after market structure shifts, like and things like that. The optimal trade entry that happens after market structure shifts. Like, dude, they all it blows my mind, bro. The longer that because I've been studying ICT concepts for like 3 years now, and every time I went through like core concepts, the 2022 model, um, I went through a lot of different videos, the OTE primer, all of those videos I went through. And like whenever I really get all of that knowledge and I combine them, they're all the same. It really is. It blows my mind. But whenever we tap into that weekly turtle soup area, you see how it has this bearish PDAs, these bearish fair value gaps, all these down close candles. It has this bearish up close candle, this bearish order block right here. So with that price, as soon as it taps in, you want to look for the last 3 candlewick swing high, which is going to be up here. What you want to see is you want to see price close above the last 3 candlewick swing high with some displacement. This is a displacing candle. It's a big ass candle that creates like a gap, okay, a fair value gap right there. It's a big candle. You want to see it displace and show I'm ready to fly, right? That's a market structure shift with displacement, and then it ends up disrespecting bearish. Watch, I'll show you. So we have this 3 candlewick swing low, then this one. Every time a new 3 candlewick swing low gets created, you just want to note it and you want to make sure that you're staying aware of it. You have this one right here, and then you have this one right here. Why? Because whenever price closes above it, that's a big ass candle, right? Whenever price closes above it, this didn't create no displacement on this time frame, but I guarantee you if we drop to the 1 hour, sometimes if that market structure shift happens and it don't have displacement on the time frame you're looking at, you could drop a time frame lower and you can end up seeing there's that fair value gap that it ends up creating. So there's a fair value gap right there on the 1 hour. We're not going to use that. What we're going to use instead is, even if it don't create that fair value gap, yeah, you could drop to the lower time frame. But what you can also do, of course, is look for that order block, that last down close candle, right? Before price had that move. So there's this down close candle right here. And then there are these down close candles. See how price closed above and disrespected even this wick, all these down close candles, it just closed above and disrespected all of that. It disrespected this one too. It closed above them. That's what I'm saying. It's disrespecting these bearish candles and closing above, because in a bearish environment, these up close candles, they support price lower because they're technically order blocks, and then down close candles support price higher because they're technically order blocks. So in those situations, price should never actually close all the way above all the down close candles. It creates a range, like the internal range liquidity, right? If it closes above that range, you can consider it a turtle soup only if you're bearish. But in this situation, since we're looking for a reversal for market structure shift, it's all applying it to the correct framework, right? The framework here is that we're in a higher time frame, weekly, external range or internal range, however you want to define it. It's a turtle soup. It's a swing low, right? Within the internal range. And that's the framework. And because of that, we want to see it flip bullish. Okay. So, with that being said, with this candle right here closing above, we look left for that last down close candle that had that actual good move. We have this one right here. This was the lowest one right there, right? When price taps into that, you can drop to the 15-minute and look for a market structure shift bullish again. Or you can take your entry right here. I talk about dollar cost averaging a lot, right? So let's say that I'm comfortable with risking 2% on this position. I'm going to risk 1% right now, and I'm going to place entry right here, stop loss right below that order block that I'm taking my entry off of. And this is off the 4 hour. I'm targeting a 1 to 2 hour. Obviously, we've seen that hit, but that other 1%, what am I going to do? I'm going to drop to that 15-minute, and I'm going to look for that market structure shift bullish. That gives me that idea that price is going to start flying. Okay. So if we go down to it, it's going to be right here in this area. Notice how I'm not really paying attention to Forex sessions. I'm not paying attention to kill zones, to London, New York, Asian. I'm not paying attention to that. Why? Because we are swing trading. We're trading based off of the weekly external range, internal range. When you're doing that, you're swing trading. And because you're swing trading, you don't have to worry about day trading within sessions, right? So with this one, if you wanted to, you could wait for all of that, but I don't think it's necessary. Being on the 15-minute, it's within a 4 hour PDA, okay? Whenever price taps in, we're looking for that last 3 candle wick swing high. It's way up here, creates a new one right here. And then it creates this new one right here, creates this new one right here. And then boom. See how all this not only closes above the market structure shifting point, this right here also, if you notice, we created bullish fair value gap that got respected, right? It's respecting bullish PDAs. What else did we have? We also had, let's see, we had this bearish fair value gap right here that also got closed above with this candle right here, right? So like in those situations, as soon as this candle closes above right here, right? Of course, we didn't see anything else. We're within this fair value gap. I personally need to wait to see something like this get closed above and disrespected, because if we're in this area and just because we have this market structure shift, we're in this bearish sensitivity area where price could still find selling volume and it could still sell off right here. So I need to wait to see price close above that area. Once it closes above that fair value gap right there, boom, boom, that right there gives me confirmation that price is ready to then take off. It's disrespecting bearish PDAs, creating new bullish PDAs and respecting them, also creating these ones, is closing over these down close candles, creating bullish order blocks and all that cool stuff, right? So whenever price does this. I talked to y'all about like how optimal trade entry is like similar and it's like the same thing, dude. Whenever you get that market structure shift, change in state of delivery, it's all the same, of course. Whenever you get that, you could literally draw your fib from that point that market structure shifted. This is point A of the low, and you draw it up to the high, right? Optimal trade entry is at 618. When price taps into that 618, you could enter and your stop loss would be below the one and everything, right? It got wicked below and it got turtle souped. But what I like to do, remember, yes, we would put our stop loss below the one, but I've talked about this in previous videos. This is how you protect your entry. Notice how we have this fair value gap also within that same area, right? Because we have that PDA, not only are we going to put our stop loss below the one of the Fibonacci level, we're also going to put our stop loss below the one candle of the fair value gap pattern. Okay. So putting our stop loss right there, you could see our stop loss was protected and never tapped out. Okay. And with this position, I always hold this scale in position for as long as the first one. So the first one, we hit a 1 to 2R risking 1%. That's a 2% gain. We scaled in on a lower time frame and we hit a 1 to 9R risking 1%. That's a 9% gain. This right here is an 11% gain setup right here. We just stood patient. We waited for our opportunities. We didn't force anything. This, in my opinion, is the best trading approach to trading. This is the best ICT trading strategy that's out there, dude. What we're taking advantage of is the weekly external range, internal range liquidity, and we're dropping to the 4 hour. And on the 4 hour, this becomes a market maker buy model in this example. MMXM, market maker model is what this is. This is the market maker buy model. Whenever the 4 hour becomes the buy side of the curve, once it market structure shifts, has that change in state of delivery, and you can draw your fib off of that. Once it does that, then it's on the buy side of the curve. And now you could start looking for weekly power of threes, weekly open, low, and it goes low and it taps into daily or 4 hour internal range liquidity, PDAs. Sometimes it even does internal range liquidity turtle soups. But that's what you want to look for now on the weekly time frames, right? You want to just go to the weekly and every single week. Don't trade Monday. I highly recommend do not trade Monday because Monday is the accumulation day. It just accumulates liquidity on both sides of the market. And from there, it engineers liquidity, right? For the open, engineering liquidity accumulating on both sides. And then on Tuesday, Wednesday, something like that, it's going to go low and it sweeps out the lows of that engineered liquidity on Monday. It taps into a fair value gap on the daily or 4 hour or an order block, something like that. Gives you that turtle soup because it engineered that low liquidity, gives you that turtle soup. That's how you trade these markets, bro. It's all the same. This is the weekly MMXM and the weekly power of three in this video. Beautiful, I know. I hope you guys got some value from this video. If you did, make sure you drop a like, comment down below if you have any questions or confusion. Comment if you made it to the end. I really appreciate you if you made it to the end. Thank you so much for watching. And if you're new here, make sure to subscribe for more videos in the future. We're going to be uploading very, very, very frequently. And shit, I don't even know what else to say, bro. I'll just see you in the next video, right? Bye.